People are often surprised when they learn about my views on real estate. They think of me as purely a stock guy, someone who only cares about equities and never touches physical property. And it's true that stocks have been my primary focus for 7 decades, but the reality is more nuanced than that. I've made some of my best investments in real estate over the years. I just approach it very differently than most people do. Let me start with a story that shaped my entire philosophy on real estate investing. Back in 1986, I bought a 400-acre farm about 50 miles north of Omaha for $280,000. The farm had been in foreclosure. Agricultural land prices had crashed after the farming bubble of the 70s burst. Nobody wanted to touch farmland. Banks were desperate to unload properties, and I saw an opportunity. Now, I didn't know anything about farming. I'd never planted a crop in my life, but I understood the basic economics. The farm could produce about $120,000 worth of crops in a normal year. At the purchase price, that represented better than a 40% return on investment. Even if crop prices fell or yields declined, I had an enormous margin of safety. And over time, farmland values would likely recover as the distressed selling ended. That farm is now worth more than 5 times what I paid for it. But more importantly, it's generated steady income every single year through the rent I collect from the farmer who works the land. I've never had to think about it, never had to manage anything, never had to fix a roof or deal with a tenant complaint. It's been one of my most satisfying investments precisely because it's been so boring and predictable. That experience taught me everything I need to know about real estate investing. You want to buy when prices are depressed and nobody else wants to own property. You want assets that generate steady cash flow from the day you buy them. You want low maintenance requirements and minimal management headaches. And you want to hold for decades, letting time and inflation work in your favor. Those principles apply whether you're buying farmland, retail properties, or apartment buildings. So if someone asked me today what real estate investments I'd make in 2026, I'd think very carefully about what makes sense given current market conditions, demographic trends, and economic realities. And I'd narrow it down to 3 specific types of investments. Not because these are the only real estate opportunities out there, but because they align with my philosophy and offer the best combination of cash flow, appreciation potential, and peace of mind. My first choice, and this might surprise some people, would be manufactured housing communities. Now, I know what you're thinking. Warren, mobile home parks, really? That's not exactly glamorous. You're right, it's not glamorous at all. But let me tell you why manufactured housing communities represent one of the best real estate investments available today. First, let's talk about the fundamental economics. Manufactured housing provides affordable shelter to millions of Americans who can't afford traditional site-built homes. We're talking about households earning $30,000 to $50,000 a year. Teachers, nurses, retail workers, service industry employees. These are hardworking people who need a place to live, but have been priced out of conventional housing in many markets. The beauty of manufactured housing communities is that residents own their homes but rent the land underneath them. This creates a very sticky tenant base. Moving a manufactured home costs anywhere from $5,000 to $15,000. It's not like renting an apartment where you can just load up a truck and leave. Once someone places their home in your community, they're likely to stay for many years, often decades. This stability of occupancy is incredibly valuable. Let me give you some numbers to illustrate why this business model works so well. A typical manufactured housing community might have 200 spaces renting for $400 to $600 per month. That's $100,000 in monthly revenue, or $1.2 million annually. Operating expenses, including maintenance, utilities, property taxes, and management, might run 40 to 50% of revenue. So you're generating $600,000 to $700,000 in net operating income on a property that might sell for $8 to $10 million. That's a 7 to 8% cash-on-cash return before any debt financing. If you put 25% down and finance the rest at 5% interest, your equity return jumps to 12 to 15%. And that's before any rent increases or appreciation. In an environment where 10-year treasuries yield 4% and stocks trade at high valuations, a 7 to 8% unlevered return with significant upside is extremely attractive. But the returns are only part of the story. What I really love about manufactured housing communities is the supply-demand dynamics. Almost nobody is building new manufactured housing communities anymore. Local zoning regulations make it nearly impossible. Neighbors fight any new development because of stigma around mobile homes. Environmental regulations have gotten more stringent. The approval process takes years and costs millions. This means existing communities are essentially irreplaceable assets in most markets. Meanwhile, demand keeps growing. The affordable housing crisis in America is real and getting worse. Median home prices are now more than 5 times median household income in many markets. Young people can't afford to buy homes. Retirees on fixed incomes need affordable options. Immigration continues to create housing demand. And manufactured housing represents one of the few remaining sources of affordable homeownership in America. This supply-demand imbalance gives manufactured housing community owners pricing power. I can raise rents 3 to 4% annually, roughly in line with inflation, and residents have limited alternatives. They can't easily move because of the high cost. They can't find cheaper housing because the affordable housing shortage keeps getting worse. And unlike apartment landlords who face competition from new construction, I don't worry about new manufactured housing communities being built nearby. There's another aspect of this investment that appeals to my conservative nature. Manufactured housing communities are incredibly recession resistant. During the 2008 financial crisis, when residential real estate crashed and apartment occupancy fell, manufactured housing communities maintained high occupancy rates. Why? Because when economic times get tough, people trade down to more affordable housing options. They move out of expensive apartments and into manufactured homes. The community I own becomes their recession solution, not their recession problem. Let me tell you about Clayton Homes, which Berkshire Hathaway acquired back in 2003. Clayton is the largest builder and retailer of manufactured homes in America. We also own and operate manufactured housing communities. This business has performed spectacularly well for us over the past 20 years. It's generated steady profits through multiple economic cycles. It's grown consistently, and it's required very little capital investment relative to the returns generated. If I were investing in real estate in 2026 with my own money, I'd absolutely look for opportunities to buy manufactured housing communities. Ideally, I'd want communities in growing markets with strong employment. Locations near military bases are excellent because military families need affordable housing and tend to be reliable tenants. Communities in the Southeast and Southwest where population is growing and housing affordability is declining. Properties that are well maintained but perhaps underperforming because of poor management or deferred maintenance. The key is buying right. I wouldn't overpay for a trophy asset in a competitive bidding process. I'd look for motivated sellers, properties that need some work, situations where I could add value through better management or modest capital improvements. Maybe the current owner hasn't raised rents in years and is leaving money on the table. Maybe there are vacant spaces that could be filled with better marketing. Maybe the property needs infrastructure upgrades that would allow for rent increases. One more thing about manufactured housing communities that I find compelling. They're not labor intensive to manage. Unlike apartment buildings where you're constantly dealing with turnovers, maintenance calls, and tenant complaints, manufactured housing communities are relatively passive. The residents own their homes, so they maintain them. You're responsible for roads, utilities, common areas, and not much else. A good manager can oversee multiple communities without breaking a sweat. Now, my second real estate investment for 2026 would be self-storage facilities. And again, I know this doesn't sound exciting, but self-storage is one of the best real estate businesses ever invented. Let me explain why. Self-storage is a simple business to understand. People need somewhere to put their stuff. Americans accumulate possessions constantly. When they downsize, when they move, when they inherit belongings, when they have a baby and need to clear out a room, they rent storage units. Businesses need storage for inventory, equipment, documents. The demand is constant and growing because people just keep accumulating more stuff. The beautiful thing about self-storage is that it requires almost no maintenance. You're renting empty boxes, essentially. There's no plumbing to leak, no appliances to break, no carpet to replace. The tenant puts a lock on the door and fills the space with whatever they want. Your maintenance costs are minimal compared to residential or commercial real estate. You might need to repaint doors occasionally or fix the parking lot, but that's about it. Self-storage also has incredibly high operating margins. Once you cover the fixed costs of property taxes, insurance, and a manager, every additional dollar of rent drops almost directly to the bottom line. Well-run facilities operate at 65 to 75% net operating income margins. Show me another real estate sector with margins that high. You can't, because they don't exist. Let me give you an example of the economics. Suppose I bought a self-storage facility with 50,000 square feet of rentable space generating $10 per square foot annually. That's $500,000 in gross revenue. Operating expenses might be $150,000, leaving me with $350,000 in net operating income. If I paid $4 million for the property, that's an 8.75% cap rate. Factor in modest rent growth and the ability to improve occupancy or add services like moving truck rentals, and the returns get even better. But what really makes self-storage attractive in 2026 is the industry structure. Self-storage is highly fragmented. There are about 50,000 self-storage facilities in America, and the top 4 operators, Public Storage, Extra Space, CubeSmart, and Life Storage, control maybe 30% of the market. That means 70% of facilities are owned by mom and pop operators or small regional players. This fragmentation creates opportunities. Many of these smaller operators aren't sophisticated business people. They're not using dynamic pricing software to optimize rates. They're not investing in online marketing and reservation systems. They're not implementing best practices in revenue management. A smart operator can buy these facilities, professionalize the operations, and significantly increase cash flows without any physical changes to the property. This is exactly what happened with the consolidation wave in self-storage over the past 20 years. The big public REITs figured out that professional management could increase revenues 20 to 30% at acquired properties just by implementing better systems and pricing strategies. If I were buying self-storage facilities in 2026, I'd focus on acquiring properties from unsophisticated sellers and immediately implementing institutional quality management practices. There's another reason I like self-storage right now. The sector hasn't overbuilt the way apartments and offices have in some markets. Yes, there's been new construction, particularly in fast-growing Sunbelt cities, but demand has generally kept pace with supply, and the barriers to entry for new construction are getting higher. Land costs have risen. Construction costs have risen. Municipalities are increasingly reluctant to approve self-storage facilities because they don't generate much tax revenue relative to other uses. Self-storage is also incredibly recession-resistant, though in a different way than manufactured housing communities. During recessions, demand for storage actually increases. People who lose their homes need somewhere to put their belongings. People who downsize from houses to apartments need storage. Businesses that close need to store inventory and equipment temporarily. Divorce rates increase during economic stress, creating storage demand. Meanwhile, people who already have storage units rarely give them up because the monthly cost is relatively small and getting rid of belongings is psychologically difficult. I saw this firsthand during the 2008 financial crisis. Self-storage occupancy and rents held up remarkably well, while other real estate sectors crashed. Public storage, which I've followed closely over the years, actually grew earnings through the downturn. That kind of resilience is exactly what you want in a real estate investment. If I were buying self-storage in 2026, I'd focus on facilities in markets with strong population growth and limited new supply. Secondary markets in the Southeast and Southwest look attractive. Places like Raleigh, Charlotte, Nashville, Austin, Phoenix. These metros are growing rapidly but haven't overbuilt storage the way some primary markets have. I'd also look for properties that are physically sound but operationally underperforming. Maybe it's a facility where the owner hasn't invested in climate control or security features and is losing market share to newer competitors. With some capital investment to add climate-controlled units, better security systems, and an online presence, you could command higher rents and improve occupancy. These value-add opportunities offer the best risk-adjusted returns in my view. One more thing about self-storage that appeals to me. The lease terms are month to month. That sounds risky. My customers could leave anytime. But in practice, it's a huge advantage. It means I can raise prices quickly when market conditions justify it. I'm not locked into long-term leases at below market rates the way office or retail landlords often are. If demand strengthens, I can capture that value immediately through rate increases. That flexibility is valuable. My third real estate investment for 2026 would be single-family rental homes in select markets. Now, this is different from the other two because it's more management intensive and less passive. But the fundamentals for single-family rentals are extremely strong right now, and I think they'll remain strong for years to come. Let me start with the big picture. Homeownership rates in America have declined from 69% in 2004 to about 65% today. That might not sound like a big drop, but it represents millions of households who are renting instead of owning, and the trend isn't reversing anytime soon. Home prices are unaffordable for many potential buyers. Mortgage rates, while down from their peaks, remain elevated. Young people are carrying more student debt and getting married later, which delays home purchases. All of these factors support rental demand. But here's what's changed in the single-family rental market over the past 15 years. It's become institutional. After the housing crash, large investors like Invitation Homes and American Homes for Rent bought tens of thousands of foreclosed homes and turned them into rental properties. They developed systems and processes to manage large portfolios efficiently. They proved that single-family rentals could be a viable institutional asset class. This institutionalization is important because it means the business model has been validated and refined. We know what works in terms of property selection, tenant screening, maintenance protocols, and technology platforms.
Individual investors can now apply these lessons to build smaller portfolios with institutional quality operations.
You don't need to own 10,000 homes to run a professional single-family rental business anymore. So what makes single-family rentals attractive as an investment? First, they appeal to a different demographic than apartments. Single-family rentals attract families with children who want yards, good school districts, and separation from neighbors. These tenants tend to stay longer than apartment renters, often 3 to 5 years or more. They take better care of the property because they're treating it like a home, not a temporary living situation, and they're willing to pay a premium for the space and privacy. Second, single-family rentals have built-in appreciation potential tied to the for-sale housing market. If home prices in the area increase, the value of my rental properties increases too. This is different from apartments or commercial properties where value is based purely on income generation. With single-family homes, I benefit from both rental income and property appreciation over time. Third, single-family rentals offer more control over value creation than other property types. I can improve a property through renovations, better landscaping, updated appliances, and cosmetic upgrades. These improvements directly translate to higher rents and higher property values. With manufactured housing communities or self-storage, you're more limited in how you can add value beyond operational improvements. Let me talk about the specific strategy I'd employ with single-family rentals in 2026. I wouldn't try to buy properties scattered across the country. That's a management nightmare. Instead, I'd focus on building a concentrated portfolio in 1 or 2 markets where I could develop local expertise and achieve operational efficiency, probably 25 to 50 homes in each market to start. The markets I'd target would have specific characteristics. Strong job growth, particularly in diverse industries, so the economy isn't dependent on one sector. Population growth, preferably driven by net migration rather than just births. Good school systems that attract families with children. Limited new home construction relative to household formation, which keeps supply tight and supports rent growth, and prices that still offer reasonable rental yields. Probably markets where the median home price is $300,000 to $500,000. Based on these criteria, markets like Tampa, Jacksonville, Charlotte, Raleigh, San Antonio, and certain suburbs of Phoenix and Las Vegas look interesting. These are growing metros with strong job markets and relatively affordable housing compared to coastal markets. The rental yields are decent, typically 5 to 7% gross, which provides cash flow and room for appreciation. Here's how the numbers might work. Suppose I bought a home for $350,000. I'd put 25% down. So $87,500 in equity and finance, $262,500 at 6% interest. The mortgage payment would be about $1,570 monthly. Property taxes, insurance, maintenance, vacancy, and property management might total another $800 monthly. So my total monthly costs are around $2,370. I'd rent the home for around $2,600 to $2,800 per month based on market comps. That gives me $250 to $450 in monthly cash flow, or $3,000 to $5,400 annually. That's a 3.4 to 6.2% cash-on-cash return on my $87,500 equity investment. Not spectacular, but acceptable given the appreciation potential and the fact that tenants are paying down my mortgage. Over time, the economics improved dramatically. Rents increase 3 to 4% annually with inflation. The mortgage payment stays fixed. Expenses rise with inflation, but more slowly than rents. After 10 years, I might be collecting $4,500 in monthly rent, while my mortgage payment is still $1,570. My cash flow has tripled. Meanwhile, the property is likely appreciated from $350,000 to $500,000 or more, and I've paid down $60,000 of mortgage principal. That's the power of single-family rentals as a long-term investment. The returns start modest but compound beautifully over time. As rents grow, mortgages get paid down, and properties appreciate. It requires patience and a long-term mindset, which aligns perfectly with my investment philosophy. Now, I mentioned that single-family rentals are more management-intensive than manufactured housing communities or self-storage. That's true. Homes have more things that can break. Tenants call about maintenance issues. You have to manage turnovers when tenants leave. But this is where technology and professional property management have made a huge difference. Today, you can hire professional property management companies that handle everything for 8 to 10% of monthly rent. They screen tenants, collect rent, coordinate maintenance, handle evictions if necessary. Modern software platforms streamline communication, maintenance requests, and financial reporting. You can monitor your entire portfolio from your phone without ever visiting the properties. This makes owning single-family rentals far more passive than it was 20 or 30 years ago. The key is being selective about property management companies. I'd interview multiple firms, check references, understand their tenant screening processes and maintenance response times. I'd want a company that treats the properties like their own, that's proactive about maintenance rather than reactive, and that keeps occupancy high through good tenant relations. The 10% management fee is worth every penny if it means I don't have to deal with tenant calls or coordinate repairs. There's another consideration with single-family rentals that's important. You need to buy right. Unlike manufactured housing communities or self-storage where you're buying cash flows with single-family homes, you're buying individual properties that need to pencil on a unit-by-unit basis. This means being disciplined about purchase prices and avoiding bidding wars with emotional home buyers. I'd focus on buying properties below market value when possible. Foreclosures, estate sales, tired landlords who want out, homeowners facing job relocations who need to sell quickly. These situations create opportunities to buy at discounts to retail value. I'd also look for cosmetically distressed properties that need updating but are structurally sound. A house that needs new paint, flooring, and kitchen appliances but has a solid foundation and roof can often be bought cheaply and renovated into a desirable rental. The renovation work itself would be strategic. I'm not trying to create showcase homes. I'm creating clean, functional, durable properties that appeal to families and require minimal ongoing maintenance. Think builder-grade finishes, neutral colors, low-maintenance landscaping, quality appliances that won't break constantly. The goal is maximizing rental income and minimizing maintenance headaches, not winning design awards. One risk with single-family rentals that I take seriously is concentration. If I own 50 homes in one market and that local economy crashes, I'm exposed, the jobs disappear, property values fall, tenants can't pay rent. This is why I emphasize diversifying across 2 or 3 markets with different economic drivers. If one market stumbles, the others hopefully remain stable. This isn't perfect diversification, but it's better than having all my eggs in one geographic basket. Let me step back and talk about what these 3 real estate investments have in common, because that reveals my overall philosophy. First, they're all focused on affordable housing or storage for average Americans. I'm not buying luxury condos or Class A office buildings or high-end retail. I'm investing in assets that serve middle and lower income consumers who need affordable solutions. This segment of the market is underserved, faces favorable supply-demand dynamics, and is relatively recession resistant. Second, all 3 investments generate immediate cash flow. I'm not speculating on appreciation or betting on development projects that might take years to generate income. From day one, I'm collecting rent, checks that exceed my operating costs. This cash flow provides a margin of safety and allows me to be patient with long-term value creation. I'm never forced to sell at an inopportune time because I need the money. Third, none of these investments require me to be an expert in construction, development, or complex financial engineering. The business models are simple. Buy property that generates rent, manage it efficiently, collect the checks. I don't need to understand complex lease structures or worry about anchor tenants leaving or navigate complicated zoning processes. Simplicity reduces risk and allows me to focus on fundamentals. Fourth, all 3 benefit from favorable demographic and economic trends. The affordable housing shortage isn't getting better. Americans keep accumulating possessions that need storage. Home ownership rates are declining, creating more renters. These are multi-decade trends that will support demand for my properties, regardless of short-term economic fluctuations. I'm riding waves that are much bigger than me. And fifth, all 3 investments have limited correlation to the stock market. Real estate provides diversification for my equity holdings. When stocks crash, my manufactured housing community keeps collecting lot rents. When the market soars, my self-storage facility keeps generating steady cash flow. This diversification smooths returns and reduces portfolio volatility, which helps me sleep better at night. Now, let me talk about what's not on my list, because that's equally important. You won't see office buildings. The office sector is in structural decline due to remote work trends. Vacancy rates are elevated and will likely stay that way for years. Landlords are facing challenges with tenant renewals and falling rents. Even in good markets, office is problematic right now. I have no interest in fighting those headwinds. You won't see retail properties. Retail has been struggling for years due to e-commerce competition. Mall department stores are closing. Big box retailers are shrinking footprints. Yes, some retail categories like grocery anchored centers and necessity-based retail are performing okay. But overall, retail faces structural challenges that make it unattractive relative to other options. You won't see hotels. Hotels are operating businesses, not passive real estate investments. They require constant management, significant capital investment and renovations every few years, and they're highly cyclical. During recessions, occupancy and rates collapse. During booms, new supply gets built that creates future oversupply. I don't want the headaches or the volatility. You won't see development projects. I'm not buying land and building new properties. Development is risky, capital intensive, and requires expertise I don't have. Construction costs can overrun. Projects can get delayed by permitting issues. You might finish a development right as the market turns down. I'd much rather buy existing properties with proven cash flows at reasonable prices than speculate on what I might be able to build. And you definitely won't see me buying property in markets I don't understand or markets that are clearly overvalued. I'm not investing in coastal California where cap rates are 3% and rental yields barely cover expenses. I'm not buying in markets that have experienced massive speculative appreciation and seem likely to correct. I want markets with reasonable valuations, strong fundamentals, and room for growth. Let me address a question that I know some people have. Warren, you've been predicting that real estate might face challenges as interest rates normalize and property values decline from pandemic highs. Why are you investing in real estate now? Isn't it risky? The answer is that I'm being selective. I'm not buying everything. I'm focusing on property types and markets with strong fundamentals and cash flow generation, manufactured housing, communities, self-storage facilities, and single-family rentals and growing affordable markets aren't the parts of real estate that got overheated during the pandemic. Those were coastal gateway cities, luxury condos, speculative development projects. The middle market, affordable housing, and storage sectors I'm focused on have seen more moderate price appreciation and offer better fundamentals today. Moreover, I'm buying for cash flow, not appreciation. If property values fall 20%, but I'm still collecting cash flow and earning 7 to 10% returns, I'm fine. I can wait for values to recover. The danger is when you overpay for properties that don't cash flow and you're dependent on appreciation to make your return. That's speculation, not investing. I'm doing the opposite. There's another aspect of real estate investing in 2026 that I think is important to discuss. Financing. Interest rates are higher than they were in 2020, 21. Mortgage rates for investment properties are in the 6 to 7% range. This makes leveraged real estate returns more modest than they were when debt was nearly free, but it also means property prices have adjusted downward in many markets, improving unleveraged returns. My approach would be to use moderate leverage, probably 65 to 75% loan to value.
This provides meaningful equity returns while maintaining a conservative debt level that can be serviced even if rents decline temporarily. I'm not trying to maximize leverage to juice returns. I'm using leverage prudently to improve equity returns while maintaining financial stability. If I can't make a property pencil with 30% down, I'm probably paying too much. I'd also focus on fixed rate financing rather than floating rate debt. Yes, fixed rates are higher right now, but they provide certainty about my costs for years into the future. I can underwrite my investments conservatively, knowing exactly what my debt service will be. With floating rate debt, I'm exposed to interest rate risk that could turn a cash flowing property into a losing investment if rates spike further. Let me talk about the timeline for these investments. Real estate is not a short-term asset class. I'd be buying with a 10 to 20-year hold period in mind, maybe longer. The first few years might produce modest cash-on-cash returns as I establish operations, fill vacancies, and implement improvements. But over time, as rents grow, mortgages get paid down, and properties appreciate, the returns compound beautifully. This long-term orientation is crucial. If I'm worried about what my properties will be worth next year, I'll make poor decisions. I'll overpay during booms and panic sell during busts. But if I'm focused on the cash flow I'll collect over decades and the long-term value appreciation driven by inflation and demand growth, I can be patient through market cycles. That patience is what separates successful real estate investors from everyone else. I'd also be thinking about tax advantages, which are significant with real estate. Depreciation allows me to shelter cash flow from taxes for years. The 20% qualified business income deduction for pass-through entities reduces my tax rate. I can defer capital gains through 1031 exchanges if I sell one property and buy another, and if I hold properties until death, my heirs get a step-up in basis that eliminates embedded capital gains. These tax benefits meaningfully improve after-tax returns. Let me wind this down with some thoughts on risk management, because real estate investing carries risks that need to be understood and mitigated. The biggest risk is over-leveraging. If you borrow too much and cash flows decline, you can lose your properties to foreclosure. I've seen this happen to many investors during downturns. They were fine when everything was working, but had no margin for error when occupancy fell or rents declined. Conservative leverage protects against this risk. Another risk is concentration. Owning one or two properties in one market exposes you to local economic shocks. Diversifying across property types and markets reduces this risk. That's why I've outlined 3 different types of investments rather than suggesting you put everything into one basket. Geographic diversification within each property type also helps. Tenant risk is real with real estate. Bad tenants can damage properties, fail to pay rent, and require expensive eviction processes.
This is why tenant screening is so critical. Checking credit, verifying income, calling references, understanding rental history. Good property managers do this systematically. It's worth paying for quality management to reduce tenant problems. Maintenance and capital expenditure risk is something many investors underestimate. Properties need ongoing maintenance and periodic capital improvements. Roofs wear out, HVAC systems fail, parking lots need resurfacing. If you don't budget for these costs, you'll face cash flow shortfalls when they arise. I always underwrite properties, assuming 2 to 3% of property value annually for maintenance and capex. That might seem conservative, but it ensures I'm prepared when expenses come. Market timing risk is probably the hardest to manage. If you buy at the peak of a real estate cycle, you might face years of declining values and challenging operating conditions. But here's the thing, it's almost impossible to time real estate markets perfectly. Cap rates compress gradually over years and then spike suddenly during crises. Trying to call the exact top or bottom is a fool's errand. My solution is to focus on cash flow. If I'm buying properties that generate meaningful cash flow from day one, I can handle temporary price declines. I'm not forced to sell. I can collect rent and wait for the cycle to turn. This is why I emphasize buying properties that pencil conservatively with the assumption that things might get worse before they get better. That margin of safety is invaluable. One final thought on real estate investing for 2026. I think we're in a transitional period where the easy money era is over, but the sector hasn't fully adjusted to the new reality. Some property owners are still hoping for a return to 3% mortgage rates and booming prices. That's probably not happening. Instead, we're likely facing a period of moderate growth, higher cap rates, and more focus on operational performance rather than financial engineering. This environment actually favors disciplined investors like me who focus on fundamentals. Properties that are well located, well managed, and serve essential needs will perform fine. Marginal properties that were propped up by cheap debt and speculation will struggle. There will be opportunities to buy from distressed sellers to pick up properties that aren't meeting debt service requirements, to acquire portfolios from over-leveraged investors who need to deleverage. I'm not suggesting the real estate market's going to crash or that we're facing another 2008. The fundamentals today are different. Lending standards are tighter, there's less speculation, household balance sheets are generally healthy, but there will be pockets of distress and repricing that create opportunities for patient investors with capital to deploy. So to summarize, if I were investing in real estate in 2026, I'd focus on manufactured housing communities for their stable cash flows and recession resistance, self-storage facilities for their low maintenance and strong operating margins, and single-family rentals in select growing markets for their appreciation potential and appeal to family renters. I'd buy conservatively with an eye toward long-term cash flow generation. I'd diversify across property types and markets. And I'd be patient, knowing that real estate wealth is built over decades, not quarters. These aren't sexy investments. They won't make you rich overnight, but they represent sound businesses serving real needs with favorable supply-demand dynamics and the ability to generate returns through complete economic cycles. And at the end of the day, that's what real estate investing should be about, not speculation or flipping or trying to time markets, just owning good properties in good markets and collecting rent checks for years to come. That's how you build wealth that lasts.